Hi, John Leonetti calling in for Pinnacle Equity Solutions, and today I want to talk to business owners about the tax implications of an internal buyout. And this is such an important topic because so many business owners are attracted to the idea of exit planning because they want to structure a plan to have their managers buy them out of the business. And at first, this all seems like a pretty good idea because the managers are going to step up and they're going to purchase the business. So the business owner, you have at some point now thought about the idea of your managers taking ownership, talked to them about them being the future ownership, perhaps spent a few years doing some succession planning and leadership development, and you even got through the hard part, which is negotiating with them about a price and figuring out how the payments are going to work. And if you're like most owners, the vast majority of your payments are going to come vis-a-vis the future cash flows that come out of the business. So your primary concerns were whether or not the business could run without you, and then your concern was whether or not you could negotiate the right deal without blowing up your management team or upsetting anybody. And now you're beyond that and you're looking at how are these payments going to be made. Well, a mistake that business owners make oftentimes is not paying attention to the tax implications of these money flows. And I want to walk you through an example because a little bit of advanced planning, far enough in advance, can avoid a lot of this dual taxation. So what actually happens is you've now passed on the business to your managers and they have to generate a profit. And let's say that they generate $1.50 in profit and roughly 1/3 of that has to go to taxes. So out of $1.50, they're going to be left with $1, which is simple enough. Tax rates corporate of 35%, so using about 1/3. Now what's going to happen next is they're going to take that dollar and they're going to pay it to you, presumably on a note payment for the stock that they purchased from you, that you extended them financing for the note that the future cash flows are paying off. Well, the dollar that they send you, even at today's capital gains tax rate, which just got extended for 2 more years of 15% at the federal level, is going to net you 85 cents. And that doesn't include state taxes and other taxes that may play a part in this as well. So if we take the original 50 cents on the $1.50 and another 15 cents, the government is getting 65 cents out of every $1.50, or 43% of the total dollars that have to be earned in order to pay you out. And it's oftentimes we find that business owners don't think this through. And if you stop and think it through, the government is actually one of the largest beneficiaries of this lack of planning because of this dual layer of taxation. And just as a note, the reason this is true is because your managers cannot take a tax deduction for the payment for your stock. So what we want to do is some advanced planning. There's a number of techniques that are available to help you mitigate these taxes and bring it down to a single level of tax. And we encourage you to talk to your advisors about these different types of strategies so that you don't get caught sending the majority of the benefit of this exit planning exercise to the government, and you empower your managers with a better structure for them to run the business profitably into the future. John Leonetti for Pinnacle Equity Solutions, talking about the tax implications of an internal buyout or sale to your managers.